Welcome to Iron Financial, the show where we help you forge a stronger portfolio and cut right through the market weakness. Today, we are putting an absolute giant under the microscope, Agnico Eagle Mines. You see, they've just dropped a set of numbers that are sending shockwaves across the entire materials sector. So the question we're here to answer is pretty simple. Have they actually built an unbreachable fortress, or is this just a temporary high ground built on a surge in gold price? Let's get into it.
Okay, let's just jump right in with the headline number that really changes the entire conversation. $4.4 billion. Now, that's not revenue, and it's not some profit on paper. That is the free cash flow Agnico Eagle pulled in during 2025. This company isn't just digging dirt anymore. This is a full-blown cash flow machine, and it's operating at an absolutely incredible scale. In a market that's just riddled with uncertainty, a number like this, well, it screams stability. It screams power. But, it also begs the question, is this performance a new standard of operational excellence, a true financial fortress? Or is it a spectacular but ultimately unsustainable peak vulnerable to even the slightest tremor in the market? We are going to find out.
So let's start by building the bull case. We're going to break down this record-breaking 2025 performance piece by piece, just to understand the mechanics behind that massive cash flow number. Are they just hoarding it, or are they actually rewarding investors? This is really the core of the argument for Agnico being a financial fortress in the gold space. Let's see what the data actually says.
Now, what's really fascinating about this slide is the pure, unfiltered confidence in the CEO's statement. Never been better positioned. Those are some seriously strong words. The CEO, Ammar Al-Jundi, he's not just celebrating a good year. He is framing it as a fundamental shift in the company's power and its potential. He's basically telling the market that this isn't some one-off event. He's claiming they've built a durable, solid base for the future. So we're going to treat this statement as a hypothesis, and we're going to test it against the hard numbers and, of course, the future risks. Let's see if that foundation is as solid as he claims it is.
Okay, this is where the story gets really, really compelling. Just look at this table. Revenue is up nearly 44%. Net income, it absolutely exploded, up 135%. And free cash flow more than doubled, up 105%. Now look at that bottom line, gold production. It's essentially flat, down a totally negligible 1%. So here's the crucial point. This incredible financial performance wasn't driven by digging more gold out of the ground. No, it was driven by margin expansion on a colossal scale. While their realized gold price surged, their costs just did not keep pace. Like their CEO said, while gold went up $1,700 year over year, their cash costs only ticked up by $76 an ounce. They captured over 95% of that price upside directly for shareholders. Now that is leverage. That is operational discipline. This is the engine that printed that $4.4 billion in cash.
And this chart just brilliantly illustrates where a huge chunk of that cash went. We're talking straight back to the owners of the company. $1.4 billion returned directly to shareholders in a single year. That's $803 million in dividends. And by the way, they just announced another 12.5% dividend hike on top of that, and another $600 million spent buying back their own stock. This isn't some promise of future value. This is cold, hard cash in hand. They're signaling to the market that 1, they believe their stock is undervalued, and 2, they're absolutely committed to direct returns, not just empire building. This is a critical pillar of the bull case, management's discipline in sharing the windfall.
And beyond just the shareholder returns, they used that flood of cash to forge what you can only really call a fortress balance sheet. They wiped out nearly $1 billion in debt in 2025 alone. At the same time, they were stockpiling cash, ending the year with a massive $2.9 billion war chest. This dual-action move, deleveraging while beefing up liquidity, is a classic power play. It massively de-risks the company from any interest rate shocks or, credit market freeze. It gives them incredible flexibility. They have the capital to weather any storm, to fund their future growth internally, and to pounce on opportunities. This right here is what a best-ever positioned company looks like on paper.
Okay, hold on a minute there. That is a very, very compelling picture. A cash-gushing machine, shareholders are happy, and a balance sheet that looks like it's made of solid steel. It's almost too perfect. And when things look this good, my job is to start kicking the tires and looking for stress fractures. Because a fortress, well, it's only as strong as its foundation, and in mining, the foundation is always the cost structure. So before we get too carried away, let's put this glowing performance under a little pressure. Let's stress test these numbers and see if we can find any cracks. Is this all operational genius, or is there something else at play?
And here it is, the first potential crack. While everyone's celebrating the 2025 performance, the company's own guidance for 2026 is flashing a pretty big warning sign. Their all-in sustaining cost, or AISC, is projected to jump by about 10%, from $1,339 an ounce to a midpoint of $1,475. Look, that is not a small increase. $136 per ounce of new cost. You multiply that by over 3 million ounces of production, and you're looking at over $450 million in additional annual costs just appearing on the books. So the real question is, where is this pressure coming from? And is this just a one-time adjustment, or is it the beginning of a dangerous trend?
Now, to their credit, the company is transparent about what's driving this. And this is where we need to dig in. 60% of bad cost jump, it's coming from external factors. Higher royalties, which are directly tied to their own assumption of a higher gold price, and a stronger Canadian dollar, which of course increases their costs in US dollar terms. The other 40% is a bit more fundamental. You've got general cost inflation hitting them at 4 or 5%, just like it's hitting everyone else. And they mention mining sequence changes, which can be a nice way of saying they're moving into lower-grade sections of their mines. So the crucial point is that a huge portion of this cost increase is out of their direct control. They're exposed to currency fluctuations and, paradoxically, a high gold price that is actually driving up their costs. That inflation part? That's just a direct hit to their margins, plain and simple.
And this right here, this brings us to the absolute core of the skeptical argument. The company's budget for 2025 assumed a gold price of $2,500. Their realized price was $3,454, so they benefited from an almost $1,000 per ounce tailwind that they did not see coming. So we have to ask the hard question, is this record-breaking performance truly a testament to superior operational management, or were they simply in the right place at the right time, riding a historic wave in the gold market? Because if it's the latter, then their entire fortune is tied to the price of gold. And a wave that comes in this strong can also go out just as fast, leaving those rising underlying costs dangerously exposed.
Okay, that's a fair challenge. The cost pressures are absolutely real, and yeah, the reliance on the gold price is undeniable. But focusing only on next year's cost guidance is kind of like analyzing a skyscraper by looking at the cost of paint for the lobby. It completely misses the entire structure. The real bull case for Agnico Eagle isn't just about the cash they generated last year, it's about the blueprint they have laid out for the next decade. They are using their current strength not just to reward shareholders, but to fund a massive, long-term growth plan that could fundamentally rescale the entire company. Let's take a look at the architecture of that plan.
And this quote from the CEO is absolutely critical to understanding their strategy: grow value on a per-share basis. See, this isn't about growth for the sake of growth, or just getting bigger to be bigger. The focus on a per-share basis is a direct commitment to avoiding the classic pitfall of the mining industry, diluting the heck out of shareholders to fund massive, risky projects. Their plan is to use their existing cash flow and their pristine balance sheet to fund this expansion organically. They believe they can increase production by 20 to 30% without issuing a flood of new shares. What that means is that each existing share would lay claim to a larger piece of a much, much larger pie. And that, my friends, is the holy grail for mining investors.
So here it is. Here's the roadmap. The next 3 years are all about stability. They plan to hold production steady, somewhere around 3.4 million ounces a year, consolidating their operations and using the cash flow from this period as the funding engine. Then, around 2030, the new projects start to come online. The growth begins to accelerate. By the early 2030s, they are targeting over 4 million ounces of annual production. This is a clear, phased, and decade-long vision. It's not some speculative dream, it's a calculated engineering and development plan moving from a very stable base to a significant step up in scale.
All right, let's look at the actual pillars supporting this massive growth plan. The first of the heavy lifters is the underground project at Detour Lake. Now, this is already one of the largest gold mines in Canada, and they are planning a huge expansion by going underground to tap into higher-grade deposits. This isn't some new discovery in a risky jurisdiction. This is expanding a known world-class asset in their own backyard. It's what we call a brownfield expansion, which inherently carries a whole lot less risk from building a new mine from scratch.
And the scale here is really significant. This one project alone has the potential to add up to 350,000 ounces of gold production every single year. Just to put that into perspective for you, that's the size of a very respectable mid-tier gold mine all by itself. And they are so confident in the economics here that they are tripling their investment, accelerating capital spending to $300 million to fast-track the development. They are clearly signaling that they see this as a high-return, high-priority project.
Okay, the second heavy lifter is the Canadian Malartic Complex, another one of their cornerstone assets up in Quebec. Here, the strategy is all about maximizing the value of the massive infrastructure they already have in place. They call it the fill the mill strategy.
Basically, they have a giant processing plant, and their goal is to develop multiple satellite deposits and underground expansions, like the East Gouldy deposit, just to keep that mill running at full capacity for decades to come. The plan is to create a true mining supercomplex.
And the ultimate ambition for Canadian Malartic is just staggering. They are aiming to turn this thing into a 1 million ounce a year producer. That is a Tier 1 production profile that only a tiny handful of mines in the entire world can claim. They're so serious about this that they're already evaluating the construction of a second shaft to access the deeper parts of the ore body. This is a long-term plan to turn a great asset into a legendary one.
All right, let's move to the third major project, Hope Bay. This one's located in Nunavut, a region in northern Canada where Agnico already has extensive operating experience with their Meliadine mine. So this isn't a new frontier for them. They're looking to develop what they believe could be the next large-scale gold mine in the region, leveraging their existing relationships, their supply chains, and their technical expertise in Arctic mining. Now, this is a greenfield project, so it definitely carries more risk, but it also offers enormous upside potential. And this is where I have to step back in. $2 billion. That's the estimated price tag for just one of these projects. That is a massive, massive capital commitment. We're talking about a scale of investment that can literally break a company if things go wrong. Delays in permitting, construction cost overruns, unexpected geological challenges. Any one of these could turn a promising project into a black hole for capital. And remember, this is just one piece of their very ambitious puzzle. The capital risk here absolutely cannot be understated.
Exactly. When you add it all up, Detour Lake, Canadian Malartic, Upper Beaver, and Hope Bay, you are looking at a total capital spend of $5 to $6 billion between now and 2030. This is a monumental undertaking. The execution risk is just enormous. They're going to be juggling multiple billion-dollar construction projects across different regions at the same time. This will test their management depth, their technical teams, and their financial discipline to the absolute limit. So the ultimate question for investors is this: can they actually build this incredible future they've designed without cracking the very financial foundation they've so carefully built? It is a multi-billion-dollar bet on their own ability to execute.
That's the perfect way to frame it. We have undeniable financial strength today, going up against immense execution risk for tomorrow. So let's bring it all together, put the bull and the bear cases on the scales, and deliver a final verdict. Is this company truly built to last?
All right, let's weigh this out. On the bull side, the evidence is powerful. You've got a fortress balance sheet with almost $3 billion in cash and hardly any debt. You have a proven ability to generate record free cash flow and a clear commitment to shareholder returns. You have a detailed, fully funded 10-year growth blueprint located almost entirely in safe, top-tier mining jurisdictions like Canada and Australia. But on the bear side, the concerns are just as serious. That rising cost structure is a direct threat to margins. The spectacular 2025 results were heavily dependent on a gold price surge that may not last. The execution risk on a $6 billion capital program is immense, and investors really need to be patient, as the real production growth from these projects won't even begin to show up until 2030.
So what's our final verdict here at Iron Financial? Agnico Eagle is absolutely forging a golden fortress. They are building a company with a scale, an asset quality, and a jurisdictional safety that could be completely unmatched in the industry. However, the price of that fortress is steep, and the construction timeline is long. This is not a short-term trade. Investing in Agnico Eagle today is a bet on management's ability to execute a complex, multi-billion-dollar construction plan over the next decade, and it's a bet that gold prices will remain strong enough to fund it. The potential reward is owning a piece of a true gold behemoth. The risk is the long and difficult road to get there. So the question you have to ask yourself is this: do you have the patience and the conviction for a decade-long construction project?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.